Hi everyone, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. Well, last week I said that the FANGs in general, save for one, were giving me the heebie-jeebies, and this week, as it turns out, correctly so. Only one of the FANGs look to be what I would call safe as a near-term investment, while 6 of the 7 have either provided outright sell signals or on the cusp of doing so. For holders of the FANG stocks, especially as a core position in portfolios, I am starting to fear the worst. Anyway, before we take a close look at the FANGs, I do like to say thanks to everyone who likes this video and all our subscribers. I appreciate your help with the YouTube algorithm, as this allows us to bring you more and better content, so thank you for that. Well, let's start off with a look at Amazon. And last week we had noted that the stock had broken below its HB3, and this year it simply accelerated on the downside. In other words, the sell signal we got last week has now morphed into a full-fledged sell signal. I don't think that there is much hope of any recovery before it gets down to the HB2 price, and that would be 12 times its book value. So we'll keep an eye on it down there. Apple, well again, Apple of course did give us a clear sell signal last week. I had kind of hoped that maybe there might be a little bit of rebound, and of course there was just a tiny little bit, but as the week progressed, the stock just picked up momentum on the downside, and I think we're going to see at least the HB4, which by the way is where it bottomed the last time that it had a setback. Facebook, look at that, it's struggling below the MSG price, and I think I do have to wonder whether it's actually giving us a preparation to a setback to its low super growth price, by the way, which would be 4.5 times its book value. Microsoft had a beautiful breakout, held there for, gosh, I think 19 straight days, and lately, along with Amazon and Apple, has simply set back below the breakpoint, and almost looks as if it's picking up steam on the downside as well. NVIDIA, well, we hadn't, it tried to break out, but we never got a confirmed buy or even anything like that, and the stock has simply picked up down momentum on the downside. Should be hitting its HB3 fairly soon. Perhaps there will be a little bounce potential down there. Although I must say that the longer term history of NVIDIA suggests that there actually might be more before we actually find a solid tradable bottom. Netflix, well, I haven't liked Netflix for some while now. If you look at the chart with, without our lines, the stock has basically been moving pretty much sideways, hasn't it? And that's because the growth of the book value of this company has been fairly strong. However, I have not had any kind of a buy signal on this stock now for some months. And accordingly, I think I would continue to avoid it. And then finally, of course, there is Alphabet. And the stock had a beautiful breakout. This has been one of the great trading stocks of the last little while. It's had a great breakout, and the stock appears to, although it is setting back a little bit, perhaps towards the mid-super growth price. That's 5.5 times book, but nonetheless it's holding up there very nicely, and I suspect that higher things may be ahead for this stock. Anyway, in summary, Amazon failed to hold its HB3 or 16 times book and rendered a sell. In doing so, that sell signal was confirmed by Apple, which had plunged sharply, also rendering a short-term sell. Well, I had hoped that we might get a bit of a rally and mitigate some of the loss of last Friday for anyone who had stayed with the stock. This has not happened, and the sell signal remains very much in force. Looking at the fundamentals of the company, it should not be a surprise that it failed to hold up. Once the buyback dynamic, which had pushed the shares up to that $2 trillion plus mark, was removed, as appears to be the case, earnings growth has only been 10.6% for the past 5 years. And looking forward, following 2021, earnings forecasts are only plus 5% in 2022, 7% in 2023, and perhaps as much as 10% in 2024. I'm thinking that Tim Cook has started to think about that $112 billion of debt that he was carrying versus the $66 billion of equity on his balance sheet, and may have wisely decided that enough was enough. If this is a correct assessment, then, as I showed you last week, Apple could easily lose up to half of its current market value. Last week, Facebook wobbled back down through support at its mid-super growth price, 5.5 times book. As you're aware, I have held this stock nervously for some time, and the evidence shows that the market is as nervous about the shares as I am. I had welcomed Microsoft into our Phantom portfolio, although, as I said at the time, I was not a true believer. This week, like Facebook, the stock failed to hold at its HB2, that's 10 times book. And if Microsoft follows the lead of Amazon and Apple, it could easily head lower. I would sell my holdings at this juncture, as I would not care to find out what this break, like that of Amazon and Apple, if that break is for real. NVIDIA hasn't been in my Phantom portfolio for some time, and it points lower. Although you may now watch that HB3, that 16 times book, for a little trading rebound. But as I said, I'm not 100% comfortable with that, because usually with NVIDIA I find that we typically get a two breakpoint setback before a real buy sets in. Netflix, for all its nice numbers and even that little fillip in its earnings trend, has yet to offer investors any satisfaction. Personally, I still would not own the shares. It might also offer a modest trading rebound at its own HB3 price, so watch this stock for that event. The one bright spot among the FANGs remains Alphabet. It's broken out nicely over its mid-super growth price and is now doing that little sort of breakout pullback routine that many stocks go through, and I usually warn you to be aware of. The buy signal was strong enough, however, that I hope it will allow the stock to hold above its mid-super growth price and perhaps then move on to the next breakpoint. So, similar to last week, my first takeaway this week is that the Standard & Poor's 500 actually continues to hold in above its super growth price. That's 3.5 times adjusted book value. I keep wondering what the overall effect of that $1.9 trillion in stimulus spending will be in the market sometime in the next month or two. And I, for one, am unprepared to try to outguess what the stock and the bond market of that is going to be. Second, as this week has underlined, the FANGs are clearly not the leaders that they once were, and worse, maybe trying to lead on the downside, as I think you all clearly saw today. Now, before you decide to tune out of our FANG Friday webcast because the FANGs have, maybe they've sort of had it, let me remind you that when growth stocks implode, they tend to do so gradually and over time, and usually offer terrific short-term trading opportunities on their way down, on the long side for most of you, but also on the short side for those of you who like that kind of trading. A little while ago, I showed our FANG Friday subscribers what happened to Coca-Cola after its bust in 2000 and on. And the trades that Coke offered were beautiful. I suggest you find that webcast and keep it close to your heart. For now, this has been Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next Friday. Until then, stay safe. This pandemic is not over yet.